Good evening. This is Alex Merrick with Ironwood Wealth Management. We'd like to welcome you all to Ironwood's quarterly Market Insight webinar. Tonight, we're very excited about tonight's call. We have various topics that we'd like to cover that many clients and individuals have been bringing up over the meetings we've had over the past few months. These include potential impacts of the election results, issues surrounding the fiscal cliff that we're hearing a lot about, as well as just general economic conditions for the U.S. and the rest of the world. I'd like to offer a special welcome to Sean Kennefic-Rogers. He is Ironwood Wealth Management's Chief Investment Officer and also a charter holder of the Financial Analyst designation. If you have questions, please type them as they come up. We will have a question and answer session at the end, and we will try to get to everybody's questions. But without further ado, I would like to turn it over to Sean.
Thank you, Alex. Welcome, everybody, to this edition of our Ironwood Quarterly Insight. I think we all ought to just hang up on the call and go about doing our own business, since there really isn't that much going on the rest of the year. Why don't we just call it a year right here with the S&P up about 15%. It doesn't matter that we have elections and a fiscal cliff, and Europe keeps poking its head up again, and China. No, and all kidding aside, we do have a lot to go over today, so I'm actually going to go ahead and get right into it. We've got the disclosures page here. Leave that up for a second. And Alex already mentioned some of the things that we're going to go over. We're going to go over the returns and the environment from Q3, and then what lies ahead for the rest of this year, in particular the fiscal cliff, how the elections are going to affect the markets or how they could play out, and some international stuff, especially focusing on Europe and focusing on China. So with that, we're going to go ahead and get into the Q3 results and environment. If you remember last quarter, we were worried about a slowing economy. We talked about a wait-and-see economy. Well, this past quarter that we just went through, things improved tremendously. Not only did aggressive asset classes climb, but many of the leading economic indicators improved hand over fist. For example, the ISM numbers during the summer came in below 50. In the last two readings, this morning we had one, and I'm referring to the ISM manufacturing number, and September we had one. September's was 51.5, which is the first month in 3 months that it was over 50. And then this morning we just had the October number at 51.7. So those have been getting better progressively, and we've kind of gotten through the slow patch of the summer. Also, the services, or the non-manufacturing index, rose to 55.1, which is the strongest reading in over 6 months. The job market picked up. We had a little bit of a stall period in the summer, and then we've now picked up the last 3 months, and the stock market did very well. So I'm going to go ahead and go through some of the asset classes and their returns. This quarter really was a risk-on quarter, and you can see that by the asset classes that performed well. Commodities up 9.7%. That would be gold and agriculture and oil and the like. Emerging market equities was up 7.9% for the quarter. International developed was up 7% for the quarter. Domestic equities were up 6.4%. Domestic large cap equities were up 6.4%. Small cap equities here in the U.S. were up 5.3%. Bonds here in the U.S. were up 1.6%. REITs, real estate investment trusts, were up 1% for the quarter. Market neutral was up 0.8%, and cash kept right on where it always will be over, well, not always, but we didn't earn anything in cash. Considering the whole year, if you've been in cash, you've earned about 0.1%. So not too much came from last quarter in that area. Like I said, the U.S. economy is improving, and I apologize if I'm going through some of these quickly. We have a lot to talk about with with the upcoming election and the fiscal cliff, so I want to make sure that we spend enough time there. So I'm going to be going through these rather quickly. But the main drivers of the U.S. economy are these two charts here, the light vehicle sales and housing starts. And you can see that through August, we've got a good trend line going. An August number was 14.5 million units. In September, we actually surpassed that, and we were at 14.9 million units in September. That's higher than the cash for clunkers, which we see right here, which was August of 2009. So we surpassed that, and we got a lot closer to our average, our long-term average of 15.1 units. So a lot of that pent-up demand, we're finally seeing folks go out and buy autos at a pace that is getting back to the average and is above the scrap rate. So we're starting to see some of that pent-up demand finally get through the system. Housing, through August, we still hadn't seen that much improvement, but 750,000 housing starts is a great number. However, in September, this number jumped from 750 to 872,000 starts. That's a huge number for the housing starts. So that's a very, very good positive sign. These two are very cyclical in nature and are leading economic indicators. So those are two great numbers showing that, yes, the U.S. economy is improving. Just to focus in on housing a little bit more, we haven't had much to be positive about in the housing sector. Prices have pretty much been going down ever since their highs in late 06, early 07. If you take a look at the Case-Shiller 20-City Index, this last quarter here, we actually were up 4.78% the last 3 months on the Case-Shiller 20-City Index. So that's a very positive sign. One of the reasons is portrayed very well in this chart here, which is monthly rent versus monthly mortgage payment. So we see that our monthly mortgage payments are at $477 equivalent versus monthly rent payments, which is $725. So it's you see this big gap here where we used to have a gap where, okay, it was more expensive to own a home versus rent a home. Now we're seeing exactly the opposite. Investors are coming in and they're buying these homes and renting them out because we have a strong rental market. Well, that's going to bring inventories down, which is exactly what we see, and it's going to bring prices up, which is exactly what we see. So all of this has to do with some of the lower interest rates that the Fed has provided us. So if we look at consumer finances, they've improved tremendously. If we look at the biggest component of consumer liabilities, almost three-fourths of it is mortgages. And with these low interest rates, folks have been able to either refinance. Some folks have just mailed the keys in. But we've really been able to lower this household debt service because of low interest rates. And you can see that because of these the mortgages are the number one, by far, piece of consumer liabilities. When we have interest rates go down and folks can refinance, it's really going to help what they have on a monthly basis to either save or to spend. And another thing that we do see is if we look at consumer assets, we're at $76.1 trillion versus a low of $65.2 trillion back in 2009, and versus a peak of $81.5 trillion in 2007. Now, these numbers are from the second quarter. So if you add in, a market that went up about 6% and a housing market that went up about 5%, we're going to be close to these 2007 numbers when we look at net assets. And so it's not great to go through a 5-year period of time where your net worth hasn't gone anywhere, but compared to our 2009 levels, you're going to feel a lot better about where your net worth is compared to those 2009 lows. So that helps confidence. which we're seeing in this morning's market, confidence was at a 4-year high at 72, and consumer sentiment, which is just another version of confidence, put out by Michigan, was actually at a 5-year high. So things are looking very good for the U.S. economy and for consumers and for confidence. We're really pleased to see these things. Federal finances, on the other hand, do not look as good. If we look at what our main problem is, it's depicted very well here in this federal outlays and receipts chart. For a long time, our average has been 20.5% spending or outlays and tax receipts of about 18% in tax revenues. Now, during the recession, not only did we lower taxes and the payroll taxes lowered, but we also had folks making less because we went through a recession, so that really hit tax revenues. You can see this big dive here in tax revenues. And then this giant spending, which is mostly attributed to the recession and the stimulus package, we've been running very big deficits, and this gap has widened. The gap currently is 8.5% from outlays and receipts. We want to try and get this gap down to 2.5% to 3%, which is what it's been running at least over the near-term future or past. If we run that gap at about 2.5% to 3%, then as we get GDP to grow at 2.5% to 3%, it will our total debt levels will stay about the same, everything else equal. So this is really what I want to dive into a little bit more and show kind of what's going on with the fiscal cliff and kind of go from there. So if nothing happens next year, current law is showing us that the top tax brackets for wage income will go from 37.9 to 43.4. Capital gains top rate will go from 15 to 23.8. Now, a misconception is that it will go from 15 to 20, but there's also the 3.8% Medicare tax on investment income, which capital gains is part of that, for folks single who make $200,000 and more, and married individuals that make $250,000 and more. So that would increase not only to 20%, but 23.8% for the top bracket. Dividends are scheduled to go to ordinary income. That's one of the areas that it sounds like they're probably going to be keeping, no matter who wins the election, they're probably going to keep them at the same rate as capital gains. But right now, with how law is scheduled, they're supposed to go back up to the same rate as ordinary income, which could have a lot of investment impacts on dividends and could really affect our after-tax return in our taxable accounts. We want to make sure that we keep an eye on what's going to happen with these two things. Payroll tax, right now we have a 2% holiday. That's scheduled to expire. And then the estate tax is at 35% for the max rate right now federally, and that's scheduled to go up to 55%. So if we, and the estate tax exclusion amount is going from 5.12 million down to 1 million at the end of this year. So this could affect a lot of folks as well. Go to the next slide here. Okay. Uh-oh. There we go. All right. Sorry about the technical difficulty. The fiscal cliff. So we talked about some of these in the previous slide, but we wanted to assign them values and what the drag really would be on the economy if these things were to happen. possible change in deficit. So the deficit is just our receipts, our tax receipts minus our outlays each and every year, and then that amount will get added or subtracted if it's a surplus, subtracted if it's a deficit, it'll be added to our national debt to give us what our debt to GDP ratio is. So possible change for 2013, if we were to have the Bush tax cuts expire across the board, we would be looking at about a $221 billion drag for next year. If we had the spending cuts that were scheduled last summer, if those are enacted, we'll have another $105 billion fiscal drag. If the payroll tax expires, that's another $95 billion. And then there's some smaller ones that add up. If you add all of them up, it's $606 billion of possible fiscal drag, depending on what happens between now and the end of the year / maybe early beginning of next year, depending on what Congress and the President do after the elections next week. So now we want to put this all together and say, okay, well, let's look at this cliff a little bit differently. Let's look at this cliff versus 2012 estimated deficit. So right now we're estimating that in 2012 we're going to run a 7.3% of GDP deficit for 2012. Now that's much better than the 10.7% GDP deficit or percentage GDP deficit we ran in 2009. So we have come down a lot, but what everyone is calling the fiscal cliff is from going from a 7.3% deficit to a 4% deficit in 1 year. So you can see we'll fall off this cliff. Don't look at the blue and the brown, but we'll fall all the way to this bottom gray if all of what's in law now goes into effect for 2013. So that'll be a 3.3% drag on the U.S. economy. Many economists agree that if we go from 7.3% deficit to a 4% deficit in 1 year, the U.S. economy will fall back into recession. Fortunately for us, most politicians also believe that to be true. So I'm going to kind of give us 4 different scenarios on what some economists are saying would happen depending on some different political outcomes for next week. So first I want to look at, okay, well, what if we have a Democratic sweep? Meaning the Democrat, and these are in no particular order. These are just in order that we put them in. So don't read into this more than needs to be read into. But if we had a Democratic sweep, we believe that the Bush tax cuts would be extended only for households earning less than $250,000 per year, along with the annual AMT fix. The top dividend tax and capital gains tax would rise from 15 to 20%. So the dividend and capital gains would both go from 15 to 20, but dividends would not go to ordinary income. The payroll tax would be phased down, so it's currently 2%. We think that it would go down to 1% for 2013 through 2015, and then be completely eliminated from 2016 onward. The extended unemployment benefits, 99 weeks of unemployment, would expire on schedule. The higher Medicare taxes to pay for President Obama's health care plan would take effect. And only the first round of spending cuts agreed to last summer, fall, would be implemented. The second round would not take effect. So that's what we think would happen if there was a Democratic sweep. And I'm going to kind of go through each one of these at the end and kind of show you where we would be as far as the deficit and as far as accumulated deficits or the federal debt by 2022 with some of these assumptions. So the next scenario, so if the first scenario is an all-Democratic sweep, the second scenario is an all-Republican sweep. If we have an all-Republican sweep, all the Bush tax cuts would be, or we think all the Bush tax cuts would be extended along with the annual AMT fix. The payroll tax cut and the extended unemployment benefits would expire as scheduled. Higher Medicare taxes to pay for President Obama's health care plan would not take effect. Only the first round of spending cuts agreed to last fall would be implemented. The second round would not take effect. Also, it seems evident that if Mitt Romney were to become president, he may try and pass tax reform and entitlement reform in 2013. So there's a little bit more uncertainty when it comes to those two things with an all-Republican sweep. Divided government 1, this would be a President Obama victory, but the Republicans control at least the House of Representatives. That's kind of what we have now. And as far as which one of these scenarios would probably be the worst for us, the fiscal cliff would be the absolute worst, where we do nothing and we fall off this cliff. We go from 7.3% deficit in 2012 to a 4% deficit in 2013. Most likely that's going to cause a recession. And if we go through another recession, growth is going to be stalled, and some of these projections probably won't come to fruition. We're not going to have a 58.5% debt level if we go through a recession and then the government has to come in and run a 10% deficit in 2014 because we caused ourselves a deficit. Second to the fiscal cliff as far as a drag to the economy would be this fiscal ledge, which is Obama presidency and Republican, at least House of Representatives. So it's kind of what we have right now. And the assumptions that we see happening in that scenario are the Bush tax cuts are extended only for households earning less than $250,000 per year, along with the annual AMT fix. The top dividend tax and capital gains tax will rise from 15 to 20%. The payroll tax cut expires on schedule. The extended unemployment benefits expire on schedule. Higher Medicare taxes to pay for President Obama's health care plan do take effect. And both sets of spending cuts agreed to last fall/summer will be implemented. So this is by far the most risky scenario of the likely scenarios, at least for the stock market short run, in our opinion. However, we believe that no matter what happens with the presidential election, if we look longer term, we don't believe that either party will let us go off the fiscal cliff, and we believe that all the scenarios, although they have different short-term impacts, we believe that longer-term equity markets will applaud either of the routes. And what's more important is not really how much we're taxing or how much we're spending, but it's really growing the economy. And because of some other things, we believe that there are some other things out there that are more important that will grow the economy than who wins the presidency next week. But with that said, we still want to go through these scenarios. So the final scenario is a Romney win, but Democrats at least keep the Senate. This would be this fiscal ladder scenario, and the assumptions we use there are the Bush tax cuts would be extended for all of 2013 for everyone. From 2014 on, they are extended only for households earning less than $250,000. With the annual AMT fix, the top dividend tax and capital gains rates would rise from 15 to 20% in 2014. They would stay the same in 2013, where they currently are, which is 15%. The payroll tax cut would be maintained in 2013, would be phased down to 1% cut for 2014 and would be eliminated in 2015 in order to mitigate some of the fiscal drag of the partial expiration of Bush tax cuts for the higher income folks. Extended unemployment benefits would expire on schedule. Higher Medicare taxes to pay for President Obama's health care plan would take effect. And then only the first round of spending cuts agreed to last fall/summer would be implemented. The second round would not. So those are our four scenarios that we kind of looked at. And just to give you an idea, because three of them are on here. This is the fiscal cliff right here. The fiscal ledge scenario would be if Obama were to win the presidency, but the House of Representatives were to stay the same, which is a 5.7% deficit for 2013. So that's right here, fiscal ledge. That's Obama president, Republican House. That would be the next. We'd be going from 7.3 to 5.7. So that'd be a pretty big drag. And that's still a pretty good cliff, but maybe we don't want to call it a cliff. Maybe we want to call it a ledge. So that's why we've called it the ledge. The next scenario would be all Democrats, which would put us at 6.3% for the deficit for next year, followed by all Republicans, which would be a 6.4% deficit, and then followed by the latter, which is the latter is the blue, which is Mitt Romney, president, and at least Democrats in the Senate. So those are the four, five options, because if we want to count the fiscal cliff as an option that we see. Now, the longer-term projection, some of these, I hate to look at this fiscal cliff option because, yeah, it looks great with 58.5% federal debt to GDP in 2022, but that never comes to fruition if, because we drop off this cliff, we cause another recession. We're going to miss out on growth, and so then we're going to have the same thing that's happened to us when we went into this recession, which is debts have accumulated very rapidly because we were running 10%, 9%, 7% deficits over the last couple of years. We would have to do the same thing if we push ourselves into another recession. So we believe that many of the politicians, many of the economists believe this way, and that's why we could see a compromise even if we have divided government. I think one of the things that both Democrats and Republicans realize is that last summer's parade and with the debt ceiling was not good for our country as a whole. And the stock market went down a ton. We just had too much uncertainty, and a lot of folks were very upset with the way that situation played out. Politicians have learned from that. That's why I believe that we're not going to see this fiscal cliff scenario. At least that's our thoughts. Yes, is it a possibility? It is. If it does happen, stock market will probably go down on the short run, and it probably, most economists would say that it would probably cause a recession. So I don't think that that's going to happen, but it is a possibility, a small one at that. So I'm sure we're going to have some questions on that. Go ahead and type in if you have any questions in particular on any of the stuff that I went over regarding the fiscal cliff and the elections of next week. With that, I'm going to move on to the Fed. We've talked a lot about the Fed previously, so I'm not going to spend a lot of time going over what they're doing, what they're up to. But in September, they did announce QE3, which is just a bond buying program. They're going to buy approximately $40 billion worth of mortgage-backed securities, agency mortgage-backed securities. If you can see here, what they announced was that they're going to be adding to their balance sheet by about $40 billion a month in this brown agency mortgage-backed securities. What that does is for those of you who haven't been on the call in the past, they're buying bonds off of the open market, and they're printing money to do so. So they're creating more money in the system to lower interest rates. They're buying bonds to lower interest rates and create money. The reason that we have not seen inflation with this is because the money multiplier has stayed very low, and the money supply growth has not gotten out of control. So even though they're printing money at historic rates, and we've seen their balance sheet triple over the past couple of years, it still hasn't caused inflation because of some of these other, the money multiplier and the money supply growth. The Fed right now is not worried about inflation because it's close to their long-term projection of where inflation should be, right around 2%. They are, however, very worried about growth. And since the Fed has a dual mandate, when they're not worried about inflation, they're going to try and focus on growth. That's why they're performing these bond buying programs to try and stabilize the market, to try and stabilize interest rates, to keep them low so that companies have a low investment hurdle. They can borrow money at very low rates and then go and use that money on capital projects and hopefully employ new folks. That's kind of what they're hoping to do from that. But at this point, they're almost pushing on a string because interest rates are at 1 point. The 10-year Treasury at the beginning of the quarter was at 1.65%. So they're very low to begin with. What does the Fed see in the future? I believe that this chart right here is going to be, and what the Fed does with this increased balance sheet when the economy starts to pick up is going to be the most important thing the important risk that we have to deal with is how is the Fed going to sop up this excess reserves, this excess liquidity that it's created to help stimulate the economy. Because it's not just the Fed, we're also seeing it internationally. And this just shows, okay, the long-term projection is around 4% for the Fed funds, and they're going to have to mop up some of this liquidity. Well, if that's their long-term rate, you know, when we get there, it's not going to be as easy as just increasing that rate. It's going to have other effects, and it's going to slow down the economy. So we're going to need to be very careful on how we do that. Not to mention that internationally, global monetary policy makers around the world are doing the same thing. So that brings us right into international markets, and we can see that growth around the globe is at stall speed. We're not breaking records for global growth right now. It's not horrible. We're not in recessionary levels when we look at the developed and the emerging economies as a whole, but we don't look robust either. Many economies are limping along, and just like I said, not only is the Fed participating in easy monetary policy, but so is the Bank of Japan, and so is the ECB. I'm going to focus here on the ECB because there's been two programs that have come out over the past year that have really helped the international markets calm down. The first one happened December 2011 when the ECB came out with its LTRO program, which is the long-term refinancing operation, which banks could go and borrow for 3 years with the ECB in their lending facilities. That helped decrease interest rates for all countries' sovereign debt, which is what was causing everyone to get worried was that those sovereign debt yields were spiking up. So that's one thing the ECB did. More recently, Mario Draghi, the president of the ECB, pledged to be a backstop for the Eurozone and stated that the euro currency is, quote, irreversible. He announced details of a bond buying program aimed at lowering the borrowing costs of Eurozone countries. So we can see the ECB has drastically increased the assets on their balance sheet, very similarly to how the U.S. did during the financial crisis, and Bank of Japan has done so as well. Here are the sovereign funding costs, so sovereign 10-year yields for Portugal, Ireland, Spain, Italy, France, and Germany. You can see that back in December, the LTRO, something happened right about here, and that was when the LTRO came, where we see these rates start to come down, Well, a couple of them kind of spiked back up. We had a little turn here, a little turn here, and a little turn here. So the second thing was, okay, Mario Draghi came out and said, okay, well, we're going to start buying bonds. The euro is, quote, irreversible. And so you can see that the second round here, even though we had some spikes up, we've seen interest rates go down. And I just went and I did a quick comparison here. Every single one of these is lower with the exception of Ireland. They're a little bit higher, but all of the other 5 countries have gone down. Their borrowing costs have come down because of these 2 programs. So the Eurozone has, at least for now, it's not a crisis, it's a chronic problem. And with the ECB, finally, with the Eurozone going from austerity to bond buying and backstopping, they put growth back into the picture, and so I think that we'll be able to, I think there's a possibility we'll be able to grow our way out of this versus trying to use austerity as the main force to drive these balance sheets back to where they need to be. Which now, we go from Europe, and the next big international zone that we want to talk about is China. One of the biggest reasons that we've had this slowdown is that China and some of the other emerging markets actually, when we were increasing our monetary policy, they were actually going through a period where you see their inflation here. Their inflation was rising to above 6%, and their money supply growth was getting close to 30%. So they were running a little hot. So what they did was they started actually tightening their monetary policy, and when they did that, you can see what an effect on inflation it had. Their inflation went back down to 2%, and the money supply went down to 13.5%. So they've got that under control, and they've started to do some more easing again. And we've already started to see signs of it. Last night in the overnight market, the China ISM numbers were above 50, and they were at their best levels in I don't know the exact data, but it was like 6 months. They're at the best levels in 6 months. And partly it's because they've started to ease again, and China's 10%. It represents 10% of global output. So when China does something like that, we've got to take notice. We can't expect them to grow at 7% forever, their GDP. They're going to start to slow down. They're going to start becoming more of a developing or a developed country, but that's still, we still have years until that becomes the issue. Right now, China is looking very positive, and we believe that we're not going to have a hard landing in China, which bodes very well for large U.S. companies that export stuff internationally, especially to China. So now, we've talked about the fiscal cliff, we talked about the elections, we talked about Europe, we've talked about China. I want to talk a little bit about what's priced in the market. And that gets us to valuations. And I've talked about valuations, I think, probably every single one of these calls. But if we look at the global equity valuations in developed markets, and we say, okay, there are different valuation metrics that we can use. We could use the forward price to earnings multiple, so that's the forward PE. We could use the price to book, price to cash flow, and the dividend yield. If we were to build a composite, which we have over here, of all four of these to get an idea of with one value, what's the valuation of this country, we can see, okay, well, we've got some composite values, and then we've got some 10-year averages. And if we plot them all out here, we can see that the all-country world index is undervalued by almost 1 standard deviation. The further the blue dot is away from the brown bar, the more undervalued that stock market is, that equity market is. So you can see that for the most part, we've got some very good equity valuations. Equities appear cheap around the globe. If we look at emerging markets, although they don't look as attractive, they still look pretty attractive with the exception of a couple with Korea, South Africa, and Mexico. But if you look at them bundled as an emerging market index, we're still below, we're still at a very decent equity valuation and still cheap compared to recent history. Not only do equities look inexpensive or cheap, but we're also getting paid to wait in equities versus fixed income. Dividends around the world are very strong relative to corresponding 10-year government bond yields. So if we just look at this chart here, equity dividend yields, Australia, US, France, every single one of the equity yields is significantly higher than the 10-year government bond yield. So everyone knows the US, this equity basket that is showed in this chart is actually the S&P 500. So if we were to buy the S&P 500 today and we put $100,000 in there, our dividend yield for the year would be $2,200 versus the 10-year government bond, which at the end of the quarter was at 1.65. We put that same $100,000 in there, and we're going to get $1,650 in interest. And oh, by the way, if it's taxable, the interest is going to be taxed as ordinary income versus the dividend is going to be taxed this year at 15%, next year possibly higher, but most likely better than a bond would. So these are very attractive dividend yields, especially when you look at after-tax effects. We're getting paid more to wait in stock. Now, we're taking more volatility when we're in stocks, so we need to make sure that we have the right time frame. But stocks do look very attractive if you look at several different metrics. And if we look at REIT dividend yields, you can look at U.S. REITs, or even you can look at U.S. or throughout the globe. You've got the same picture. It's even higher dividend yields versus the 10-year or the 10-year government bond for that corresponding country. So we're getting paid to wait in equities, and they look relatively attractive. What else can we say about equities? Well, corporations are sitting on a lot of cash, a ton of cash. This is just a chart from late 2000, early 1999, and you can see that this line has gone directly up since the recession that we had back in 2001, and then spiked up again after the recession that we had in 08, 09. Companies cannot sit on cash earning less than 1% for very long. Although it's been seen as maybe stoic to hold cash on the balance sheet just in case we've gone through a double-dip recession, at some point these CEOs of these companies are going to start to look foolish for not utilizing some of this cash to either grow the business, which is shown in this chart over here. What can we do with this cash? Well, we can use it and use it for capital expenditures or M&A activity and try and grow our business, or we can simply pay it back to shareholders via a dividend, which we've already talked about, and you can see dividends have increased dramatically recently, or we can do share buybacks. Share buybacks theoretically should increase the individual stock. You know, if we're looking at this as an S&P 500, if we're looking at S&P 500 companies, the S&P, the more companies buy back their shares, the more the S&P should go up, and you should have capital appreciation. So those are the different ways that they can deploy this cash. At some point, it's not going to look stoic to have this, 30% cash of current assets on your balance sheet. It's going to start to look foolish, and they're going to start to need to do either one of these things. And that should bode very well for the stock market. I just put this one in here because not only are companies sitting on a lot of cash, but total household financial assets. You can see that folks just decide to increase their cash holdings at very bad times. Usually when the S&P 500 is at a low, we've got near the highest levels of cash because people are selling out of the market. They don't want to be in a market when it's going straight down. But what happens is they don't get back into the market until it's recovered, and that's exactly what we're seeing here as well. And so as some of this cash comes off of the sidelines back into equity and back into bond funds, you'll see equity markets and bonds benefit from this. Now, from 2009 until 2012, most of this cash that's been sopped up has been not going into equities. It's been going into fixed income, and I'll get to that here in a very short period of time. Actually, it's in the next slide. But first, I want to just say, cash, as most of you know, cash is not earning us very much. In 2011, we could get a 6-month CD, renew it twice, and our total interest for the whole year on a $100,000 investment would be $400. So that's a 0.4% rate of return. With inflation above 2% or right around 2%, you're losing purchasing power by being in a CD. So not a great investment choice. I want to get back to where all this cash is going right now. All this cash is not really going into equities. It's going into fixed income. We have two things that are happening that are pushing down interest rates. One, we have investors flocking to bonds. They've looked back at the past 10, 15, 20, 30 years, and they've seen interest rates. They've looked at total return of a bond or a bond fund, and they see, oh, wow, bonds have done very well over the past 10, 15, 20, 30 years. Well, this picture right here shows why bonds have done so well. Interest rates have gone from 15.84% on the 10-year Treasury all the way down to 1.65%. So they've had this tailwind, which as interest rates go down, that helps bonds' total return. I'll show you exactly how interest rates affect the principal of a bond in a few slides. But another thing I wanted to point out before we leave this slide is folks that are parking their money in 10-year Treasuries are actually losing to inflation as well. Inflation's close to 2, so as of September 30th, if you're buying a 10-year bond at 1.65%, you're actually losing a tiny little bit of purchasing power to keep that money safe. You can see in history, since the 60s, there have only been 3, maybe 4 if we count this little period here. We've had one period that didn't last for very long, another period which didn't last for very long, and then now we're presently where we had negative real yields, meaning the 10-year nominal rate, which is 1.65 on the Treasury, minus your inflation rate, gives you your real yield. So they don't stay, real yields don't stay negative for very long. The reason is somebody's putting their money in a 10-year Treasury. Let's just say they're putting in they're foregoing buying 100 gallons of milk to buy 96 or 97 gallons of milk 10 years from now. Folks don't usually do that. The only reason that they're doing that right now is because there's a lot of fear in the market, which is starting to subside. Now we have some uncertainties that are adding to that, but that's why we see rates this low, along with the Federal Reserve is buying a ton of bonds every single month, and they've increased their balance sheet threefold over the past 3 years. This slide right here, just focus on these two bottom graphs. If this isn't completely obvious what's happening here, don't even worry about this top fund flows. It's better if you look down here. It shows it a little bit better. Since 2009, just look at the blue. The blue is fund flows into bonds, into bond funds since 2007. We've had $1.3 trillion almost into bond funds. Over that same period of time, we've had $209 billion into stocks. This tells me that there is a dislocation in the market. When you see this much flows into one asset class versus another, when we're talking about stocks and bonds, if we were to look at in the 90s, when we had the stock boom, we would see something very similar to this, except for the blue line would be stocks and the gray line would be bonds. So in my opinion, we are setting ourselves up for a bond bubble, if it's not already there right now. This other graph is just another way to show. It's just the difference between flows in stocks and bonds. So in every period here, we had more flows into bonds than into stocks. We had 4 months where we had more flows into stocks than into bonds, and then a whole bunch more into bonds, and then the most recently we had a $51 billion inflow in August into bonds. So we are really concerned with bonds right now and a possible bond bubble. With that said, we know that bonds have to be a staple of a diversified portfolio. We don't know what Congress is going to do tomorrow. If we go over the fiscal cliff, bonds may go down from 1.65 to less than 1%. Who knows? But we want to make sure that we know what kind of bonds we do own. And we want to know all risks involved, not just market risk that everyone sees every day when they see, oh, the S&P is up, oh, the S&P is down, oh, the international markets are up, they're down. That's market risk. That's very visible. Interest rate risk is not as visible. There are other risks that we want to make sure that we are aware of in our portfolio, but this is one that I just wanted to highlight. So if we have a 10-year Treasury and interest rates go from 1.65 to 2.65, your bond is going to lose 9%, or roughly 9%. If interest rates go down by 1%, your bond value is going to increase by 9%. That's just it's just if you wanted to sell that cash flow. So I think an example works the best when you're trying to illustrate this. Let's say that I bought a bond today for 2%. So I bought a $100,000 bond. It's going to pay me $2,000 per year. Tomorrow, I could buy that same bond or a very similar risk bond with the same risk characteristics. I can buy it, but now for 10 years, my cash flows are 3% or $3,000. Well, in order for, since I'm locked into that 2% bond, in order for me to sell that on the open market to somebody else who can go out and get a 3% bond, I'm going to have to discount that $100,000. If I'm going to sell that bond, I'm either going to hold it and get my $100,000 back in 10 years and earn $2,000 a year, and I will miss out on opportunity cost, or I could sell that bond for, let's say, $91,000, and then I could take that $91,000 and buy a 3% bond and be in the same exact position had I held on to the $100,000 bond at 2%. That's how the bond market works. So an increase in interest rate is bad for your bond principal. If you're going to go sell that bond and want to do something else with the money. And so this chart just shows, mortgage-backed securities have less interest rate risk than TIPS. And munis have the most interest rate risk when you look at all of these different bonds. The longer your bond, so a 30-year Treasury, has more interest rate risk than a 10-year Treasury. So what we've done with the Ironwood portfolios is we've tried to shorten our duration and shorten or decrease our interest rate risk, because we do believe that interest rates are going to go up at some point, and when they go up, it's going to be very violent, or that's at least our thoughts. Another chart that just points this stock versus bond mix, it just points it out. Another kind of quiver in the hat is this chart here, which is the S&P 500 earnings yield versus the BAA bond yield. If we look at earnings for S&P companies, the earnings are coming in at 7.7% of the price of the S&P 500. So if we were to look at the S&P as kind of a bond, if we were to kind of look at it that way, we'd be earning 7.7% in interest on this S&P bond in earnings. And so companies either have to give those earnings back to shareholders, or they have to reinvest them in their company. Right now, they're putting them on their balance sheet in cash. We already talked about what that cash needs to do. Investors are not going to be happy with that cash sitting on the sideline earning 1%. Eventually, they're going to have to do something with this. So you can see that back in the 90s, it was exactly the opposite of what we have now. We had bond rates at high levels, and we had the earnings yield at a very low level. This was a very good time to buy bonds, not a very good time to buy stocks. Now we completely have reversed that trend. It's a great time to buy stocks, not so great time to buy bonds, is what this chart is trying to depict. Another valuation metric, this just is looking at lagged PE ratios. As of September 30th, our lagged PE ratio was 13.2. That's not close to the average during an expansion, but it's not the average during a recession. So we're still below the average, and we should really be in an expansion or a recovery phase. So we still believe that this number could go up, which would equate to a higher S&P. So just another valuation metric. This one's really good. This one I'm going to spend a little bit of time here on this slide, because I think it's really important. And I've talked about this one in previous presentations. This first graph is just showing your return. Okay. So what I'm trying to tell everyone is, if we have low PE ratios, that's typically a good time to invest in equities. Right now we have a 13.2 PE ratio. That's a low value for price earnings, and that tells us that stocks are cheap. It doesn't always play out in 1 year that just because stocks are cheap means it's a great investment opportunity over 1 year periods of time. We've got a PE ratio of 13.2. If we do a scatter plot of every quarter where the PE ratio was versus the next 1 year's period of return, we get this scatter plot that doesn't have any rhyme or reason. We have the computer do a regression. The standard error is 17%, so it's not really telling us much. 1 year, it doesn't matter if the PE ratio is 13.2. I can't tell you that next year we're going to have a great year with returns just because the PE ratio is very attractive. we need to make sure that we have the right time frame to be in stocks, because if we say, okay, let's not look at 1-year periods, let's look at 5-year periods. Well, now you can see that the 5-year periods, now we're actually showing something that may be relevant, and our standard of error was only 5.7% in this regression analysis. This is implying that at our current PE level of 13.2, if we were to look at history and we were to do a regression analysis, this is saying that our implied annual return over the next 5 years, with this in mind, could be 13.1%. Just to say it a different way, 13.1% average return per year for 5 years, that takes $100 in today, and it makes it $185 5 years from now. So we almost double our money in 5 years if this 13.1% were to play out over the next 5 years. My only reason for bringing this up is not to say that we're going to go up 13.1% or better over the next 5 years. I'm just saying there is a good relationship between PE ratios and the following 5, 10-year periods of returns. You want to buy stocks when they are relatively cheap. Relatively cheap, a PE of 13.2 is telling us that that is relatively cheap. I can't tell you what's going to happen next year, but I can tell you that there's a pretty good chance, if we look at history, that buying stocks with a PE ratio of 13.2 will be a good thing 5, 10 years down the road. So that was why I wanted to spend a little bit of time on that slide there. Even though we aren't really impressed with bonds currently, we still own them for our clients. We're going to own a little bit more stock than bonds, all else being equal. If somebody came in and we went through their goals and we said, okay, Mr. and Mrs. Client, you really should be a 50-50 portfolio, 50% in aggressive assets, 50% in safer type assets. You know, we may skew that to 53-47 because we don't really like, or we think there's an opportunity in aggressive assets, but we also don't want to compromise our clients' goals for retirement or you know, their second house or they're sending their kids to college or whatever their financial goals may be. We need to start with a diversified portfolio. We can never just get rid of an asset class because we don't like it. Because as noted in the tech boom, things can go on for a lot longer. The bond rates could stay low for, I mean, I've been saying that bond rates need to go up for 2 years now. I've been wrong for 2 years. At some point, if I keep saying it, you know, bond rates are going to go up. But that's the whole point of having a diversified portfolio. Not only that, but not only do we not know what's going to happen tomorrow or next week at the elections or next year or 5 years from now, and you know, that's one of the reasons you want to have a diversified portfolio. But the other reason is we can actually build a diversified portfolio that has a smaller standard deviation and a higher return. So that's the ultimate goal, is to build the best return scenario for your level of risk that we're able to take for your investment goals. And that's really what we try and do. What we don't want to do is be the average investor here and chase returns. Right now, I think the average investor is chasing bond returns. They look at the risks that have been in bonds. There hasn't been much risk in bonds. I mean, there was a little bit of dip in bond prices in 2008 when the recession hit, but for the most part, if you've invested in bonds, you've done very well. And so folks are looking at where the hockey puck was versus where it's going to be. And so we don't want to be looking where the hockey puck was and then selling and getting what the average investor gets. We want to build a diversified portfolio of all of these asset classes and make sure that we're not making knee-jerk reactions and ending up with a much lower investment return, but still taking risk, equivalent to equities or gold or oil or REITs or even bonds, So that's diversification, and that's not trying to outsmart the market. The other thing, and I've hit on this a couple times in previous slides, is you want to make sure that you have the right time frame for stocks, bonds, cash. If you're going to be invested for 1 year, you're paying for a wedding or paying for a car or paying for college next year, you don't want that money in stocks. I can't tell you, just because the PE ratio looks attractive, that the market is going to do well next year. In fact, the best return for the S&P 500, the best 1 year return has been up 51%. The worst 1 year return has been down 37%. So I can't tell you that a good investment strategy is to put $100,000 in equities when you know you're going to need that money 1 year from now. I can't even tell you to do that in bonds. And then a 50-50 portfolio, I still can't tell you. 1 year should not be in the stock or bond market. If you know you're using your money in 1 to 3 years, let's say, you really can't get that aggressive with it. If we have 5 or 10 or 20 years, or a combination of each of these, somebody in retirement, they need money every single year. And so we can build a portfolio that matches their liabilities with their assets. But just kind of going off of this example again, if we were to have a 5-year time frame and we were to build a 50-50 portfolio, looking at 1950 to 2011, this is including the financial crisis, there hasn't been a 5-year rolling period where we had a 50-50 portfolio and we lost money over 5 years. The worst case is 1% per year, which is better than what cash is giving us right now. So I'd rather be there than be in cash, because I know at least I'm earning my dividend yield and I'm earning my interest, and it's somewhat tax advantaged, and as long as I have a 5-year period of time, I'm most likely going to be doing better than a cash investment in a 50-50 portfolio. I'm going to take a lot of the risk out of the market. If I go to the opposite end of the spectrum and I have a 20-year period of time, I have a huge amount of conviction that an all-equity portfolio is going to be where your best rate of return is. But still, that might not be the right portfolio for everyone, depending on their risk tolerance. Because if we say we have a 20-year period of time, in the very first year we have an all-equity portfolio, we're hoping to get somewhere between 6 and 18%. If in the first year you have a negative 37% year, and that goes past your comfort level, and you sell out, then we didn't do our job either. So we need to make sure that, one, we have the correct time frame, we have the correct risk willingness, and we have the correct risk ability. And so at Ironwood, we really try and bring all of those together to build a diversified portfolio that's going to hit each and every one of our clients' goals with the highest probability. Investment implications. Right now, with global monetary policy being very easy, we're going to be overweight commodities. International equities look slightly more attractive than domestic equities right now, so we're going to be a little bit more overweight to international. Floating rate bonds, as interest rates go up, floating rate bonds, their interest rate adjusts every 90 days, so we're not stuck into a long-term bond, and so they have much less interest rate sensitivity. Market neutral is another way we can get some safer type assets without being in fixed income. We're underweight things that will do poorly when interest rates go up. So fixed income, long duration fixed income will not do well when interest rates start to go up. Treasuries will not do very well when interest rates go up. Precious metals, we believe they're a good insurance play on the portfolio, but we believe right now they're a very expensive insurance play. So we do have some exposure, but we're definitely underweight versus our normal benchmark weighting in precious metals. And then cash, I've already spoken about cash a few times, but we're underweight cash assets too. We'd rather be a little bit overweight in some of our equities versus our cash. Now, the final slide here is just showing, a lot of people speak about the dead decade, and I like to focus on this asset allocation, which just happens to be 25% S&P 500, so that's domestic large cap, 10% Russell 2000, which is small cap, 15% large cap international, 5% emerging markets, 30% in the Barclays aggregate, which is a domestic bond index, and 5% in the market neutral index, and 5% in the commodity index, and 5% in the REIT index. So this is a portfolio I would probably say is about a 60-40-ish portfolio, very moderate, but it's very diversified. And if you take a look, every year the best an asset allocation portfolio ever does over this entire 10-year period is its third best. However, if we look, or I'm sorry, fourth best. However, if we look at the 10-year cumulative, it's third best with a much flatter. You're not going all over the place with this asset allocation portfolio, yet you've earned 6.2% annualized or per year every year, or I'm sorry, yeah, 6.2%. I actually might be 8.2%. That's 8 point. No, it's 6.2% annualized every year versus some of these other asset classes, and we have a much more diversified portfolio here. The other thing that I like to mention on this graph is cash. We actually added this to this graph, and you can see that cash under, there's only a few years that cash does really well, and it's not because cash does really well, it's because all the other asset classes do very poorly. But cash is not a long-term solution. Over the last 10 years, you would have made 20.2% in cash, which is 1.8%. If you would have just stuck your money in the S&P 500, even with 2 recessions, you still would have earned more money in the S&P. So diversification is very important. With that, we're going to go ahead and open it to questions. So I'm going to pull up our question board here.
Great job, Sean. Folks, this is Alex back again. I think you did a wonderful job of taking a lot of information and condensing it, as well as taking some tough concepts and making them nice for us to be able to understand. So we have several questions here. We just went through a period of corporate earnings reporting. How are U.S. companies doing? You touched on that a little bit.
So, and I apologize, I meant to say this. The second quarter of 2012 was the best ever earnings quarter for the S&P 500. We were just north of $25 per share, and that is the highest level that earnings have been ever, which is telling me that it's not really an earnings problem that we have. it's a confidence problem. It's a paying for those earnings problem. And so that comes into play with PE ratio, or I'm sorry, with confidence levels, with having some of this uncertainty, be certain, just getting past next week and knowing who the eventual president and House and Senate will be, will take uncertainty off the table. That'll probably be positive for the markets just because uncertainty is coming off the table and people can be more confident going forward. Companies can be more confident, they can plan long term, and we can get through some of these things that are hindering our price earnings multiples, specifically confidence.
Great. I think this is a great follow-up question, actually, by a different person. Somebody asked, I have to tell you, I think it's great. Somebody requested that we send some slides and graphs to Mitt Romney, please. That's pretty funny. You know who you are. Okay. This is a good one. Do you think that we're still trading in a fear-based environment? What will you look towards to indicate that investors are starting to enter a period of greed?
So I still think that this is a fear-based market, and you can see that by the levels of cash that investors are holding, and even CEOs on corporate balance sheets. You can also see that people are not going into equities right now. They're taking their cash, and if they are redeploying it, they're not putting it in equities, as seen by the fund flows. They're putting it into bonds, which tells me that we're taking the first step to get over that fear of 2008, 2009, but we're not quite ready to go full board into equities. And until we start to see some of those equity flows go up, I think that we're going to be at these PE levels. But once we see flows into equities, the stock market could jump 20% very quickly, and that's when we see PE multiples go up to 15, 16, and that's when you start to see the media, instead of focusing on the fiscal cliff and how are these negative things, they're going to start to focus on, okay, investors are starting to miss it now. Once we get to 1565 on the S&P 500, the media attention is going to focus more on, are you missing it? And that's really when we want to be careful. Those periods of time can last a long time. So we don't want to dump all of our equities at that point. We still want to keep fundamental, sound financial planning and portfolio diversification, but at that point in time, I would think that we would be heading toward more greed, and we could start pulling back some risk.
Good, thank you. Here's a last question. I understand you recently got married. Are you still happy?
Yes, I am still happy. I've been married 1 month, and we're still married. I'm happy. I'm a happily married man. Thank you.
I love it. That's a funny question. Well, guys, with that, I think we'll wrap it up here for the evening. Should you have any other questions, please feel free to send either Scene an email, or you may certainly send me, Alex, an email as well, and we'll be sure to get back to you. Other than that, everybody have a great evening, and we will talk soon. Take good care. Bye-bye.
Thank you.